I'm Ben Peele, UK Managing Director of PortfolioMetrix, and I'm here virtually, of course, with Nick Spicer, our UK Head of Investments. So, Nick, that was a pretty extraordinary quarter, wasn't it?
It was indeed, Ben. The first quarter of 2020 did see a sharp sell-off in almost all assets globally. This was, of course, because of two twin interlinked shocks. Obviously, the COVID-19 pandemic, and linked to that, an economic shock exacerbated by an oil price sell-off caused by the aggressive social distancing that is necessary to suppress the pandemic. During the quarter, it was UK equities of smaller companies globally, and cheaper stocks in general that were particularly hard hit.
You mentioned risk assets. What about bonds? What happened there?
So bonds, government bonds, sovereign bonds, high quality developed market issues they actually performed quite well as central banks lowered rates and restarted quantitative easing to cushion the economic shock. Riskier bonds, on the other hand, actually performed a lot less well.
Okay, but it wasn't just bonds which saw volatility, also currencies were very active during the quarter. What can you tell us about currencies?
Yeah, so the pound weakened significantly against most other developed market currencies. This was on a general flight to safety as investors sought out the perceived safety of larger economies like the US, Japan, and the Eurozone.
Thanks, Nick. And now, can you provide our advisor partners some insights on specific falls within that wider sell-off, both by asset class and by region?
Of course. Developed equities overall, as measured by the MSCI World, fell 15.7% over the quarter. The FTSE 100, as I mentioned, actually fell more than that, so 23.8% over the quarter. Emerging markets were down 18.4% over the quarter. Those higher quality investment grade bonds were actually up 1.4% over the quarter. And high yield, riskier bonds fell 15.2% over the quarter.
Okay, so fairly sizable moves there. You mentioned UK equities were particularly hard hit. Are there any other patterns within the performance of equities that our advisor partners should be aware of?
Yeah, absolutely. If you remember, I said developed market equities fell 15.7% over the quarter, but growth, momentum, the more expensive equities, they actually only fell 9.4%, so 6% less than that overall number. Value cheap equities fell 22%, so 4% more than the broader index. And smaller companies actually performed worse, so they were down 25.3%, almost 10% more than the broader, largely big company index.
Okay, that's helpful to see how markets or wider markets have performed. Can you now perhaps give our advisor partners some insights as to how the PortfolioMetrix portfolios performed during this very turbulent time?
Well, of course, in such an environment, our portfolios did fall. So Select 1, our low-risk portfolio, fell 6.3%. Select 4, our mid-risk portfolio, was down 15.9% net of all investment fees over the quarter. And Select 7, the highest risk of our main portfolios, was down 22.3% net of all investment fees over the quarter. We obviously run a number of different approaches, so clients can be invested in any one of those, and they all perform slightly differently. But our ethical emphasis portfolios did particularly well over the quarter, given their quality growth focus. Just to give you an example of that, ethical emphasis for the mid-risk portfolio was down 10.9% over the quarter.
Okay, interesting to see the fact that ethical is actually performing relatively well. This is certainly a time when we're getting a lot of incoming interest in ethical from both advisors and their end clients. Also encouraging to see the fact that that risk separation, which we pride ourselves on, held up during what was obviously a very volatile period. So, Nick, on the question that everyone wants to know the answer to, is there any sign of this pandemic being brought under control? Is there any light at the end of the tunnel?
Yeah, there were some tentative, and there are some tentative signs of progress with regards to COVID-19. Hospital admissions, critical care cases, deaths, they're now falling in Italy, Spain, and France, the worst hit of the European countries. And of course, they're already way down in China. Hopefully, we're also seeing the beginnings of a leveling off in the US and the UK. That said, we have to be careful because the resurgence is always a possibility. But if we get the testing right, and if we can repurpose some of the some existing drugs to actually work against the disease, that should allow us to actually control the virus until a vaccine is available.
Okay, so potentially some good news on the horizon. And you mentioned right at the outset that this is not just about the virus, it's about the dual shock of the impact on the economy. Can you give our advisors some context as to how big that fallout from a macro perspective could be?
Yeah, unfortunately, we're only at the beginning of what's likely to be, quite a severe recession. Expect the Q1 GDP numbers when they come out in a few weeks' time to be pretty grim, and those for the second quarter to be actually worse. Deloitte are talking about a contraction of maybe 14% in the second quarter for the UK. That's going to feed through to company earnings. And of course, you've already seen a number of companies actually cut their dividends and more may follow. But what really matters is actually what happens in the second half of the year. Provided we have the virus under control, we should see a powerful resurgence in economic growth, and with that, company earnings as well.
So it sounds like the hard data is likely to get worse before it gets better, and yet we've actually seen a decent bounce in the markets and risk assets in April after what was obviously a fairly grisly March. Is this a case of markets and investors trying to look through the bad news and actually anticipate the recovery when it comes?
Yeah, absolutely. That said, so investors are looking through, which is getting that bounce, but it is possible we could see further falls from here if investors instead decide that maybe the recession will be deeper than expected, or actually the recovery will be slower.
Okay, that's helpful. So this has been a very tough quarter for everyone. Can you give our advisors some insights as to what you and the team have been doing, both in terms of on a daily basis, but also in terms of whether you've been making any more structural changes to portfolios?
Yeah, absolutely, Ben. So a lot of what we did that was helpful, actually, we did a long time ago. So diversification always helps you to avoid the absolute extreme outcomes, including the negative extreme outcomes. We didn't invest in some of the sort of the worst investments out there. So UK direct property funds, for example, which actually gated, so stopped investors withdrawing any money because they couldn't value the underlying assets. We avoided those going into this difficult situation. During the actual quarter, we've mostly been trying to avoid unforced errors. So we haven't been making any knee-jerk changes to portfolios in the midst of the sell-off. That said, we have been undertaking some rigorous rebalancing in the form of trimming bonds that performed relatively well, and topping up equities, post the falls that they actually saw. We've also been chatting to our underlying active managers a lot, trying to make sure that they've been sticking to their mandates and styles. And what the sense we get from them is that overall they are stress testing their underlying holdings, topping up those they think will survive, because it's all about companies actually surviving this very difficult period, and selling those that they actually lack the conviction will survive in this new world that we're seeing. So in conjunction with that, we're also looking to the future. So we're trying to get a better sense of what the post-COVID-19 landscape actually looks like. And as that becomes a bit clearer, you can expect to see some more changes as we alter the portfolios.
Okay, thanks. This is also worth reminding our advisors that we had zero exposure to commodities as well, which were perhaps the worst performing asset class during this period. And Nick, final question from me. What would you leave our advisors with? Any final thoughts on what's clearly been a very challenging quarter, and to give them some talking points for when they speak to their clients?
Yeah, so it's very easy to lose perspective in the midst of a crisis. And it's helpful to look at history to get a sense of what's happened in other crises. So for some context, the 20th century contained 2 world wars, a major pandemic in the form of the 1918 Spanish flu, a Great Depression, a Cold War, various nuclear disasters, oil embargoes, a number of major terrorist incidents. And despite all of those terrible events, equities actually performed spectacularly over the century as a whole. So I think we have to keep that in mind. Yes, it was a very difficult quarter, but there will be a post COVID-19 world, and equities will ultimately recover. So yeah, the final thought really is it is we should always pay attention to risk. But overall, in the long term, it actually pays to be optimistic and to look for those opportunities that are always emerging.
Thanks, Nick. I think that ties in very nicely to the webinar which Nick did for our advisor partners on the importance of composure. For anyone who hasn't seen that, let us know. We can send you the link. So all that remains to say is, Nick, thank you for your insights as always. Thank you to our partners for listening in. And if there's any questions or topics that you'd like covered on the next one of these quarterly video updates, then please let Nick or I know via email. And last but by no means least, we hope you, your families and your colleagues are all keeping well during these challenging times. And if there's anything Nick or I or the team at PMX can do to help, then please let us know. Thank you and keep safe.